Okay, sir. Okay. Okay, so very good morning to one and all. Today we are going to start with the topic buyback of shares. It's a very, very important topic from the practical perspective as well as from the theoretical perspective. And bits can also be asked from this particular topic. In the last class, we have seen regarding what is share capital, types of share capital, what is forfeiture and surrender. Here, the term buyback is generally used only in case of equity shares. Okay, redemption is used for both the preference shares as well as for debentures. But when it comes to buyback, it is used only in case of equity shares. So why the company is need to buy back? Last class we have seen, last class I have already told that redemption of preference shares and redemption of debentures. The main purpose for redemption of preference shares and debentures is the company will reduce the capital in order to reduce the fixed cost commitment. Because in case of debentures and preference shares, it's mandatory for the company to pay the fixed interest or fixed dividend in case of preference shares as per the terms of agreement. Okay, so there is certain period limit given in the Companies Act. In case of preference shares, it is 20 years, and in case of debentures, it is 10 years. After that, it is mandatory for the company to convert these debentures or preference shares into equity shares or to redeem them. Okay, any as per their requirement, they will implement that particular way, whichever is possible for the company. Okay, so that is why the term redemption is used only in case of debentures and preference. You cannot use for equity shares, but the term buyback is used for equity shares. Ma'am, what is the need for buyback? Why the company is going for buyback of equity shares, ma'am? Because in case of equity shares, there is no mandatory rule that company every year have to declare dividend to equity shareholders in order to pay this particular percentage of dividend. Because in case of equity shares, the dividend is paid by the company when the company is having surplus profits, and the rate of dividend keeps on fluctuating. It is not same for all the years, because the rate of dividend will be decided by the board, and it is declared in the general meeting as per the resolutions passed by the shareholders in the general meeting. Okay, so there is no mandatory provision in case of equity shares that the company need to pay the dividend every year. So and then what is the reason, ma'am, why the company want to reduce, why the company is going for the buyback? So if there is no fixed cost or fixed commitment for the company, no ma'am, to pay the dividend, here still the company goes for buyback because of these reasons. What are those reasons? In the sense is, if the company want to increase the value for the share, or if the company want to reduce the number of equity shareholders, because of there is a control in the there is a dilution in the control and management of the company. In order to reduce the dilution, or in order to increase the value of the share, because if the number of shares decrease, the value of the share automatically increased in the market. And if they want to keep that control and management in only few hands of few equity shareholders, they may try to reduce the number of equity shareholders. If they give away the amount and reduce the number of equity shareholders, these are the benefits which the company would derive. Okay, it may the value of the share also will increase in the market. Okay, so when the company will go for buyback, the company can go for buyback only if they have surplus profits. Okay, without any surplus profits, the company cannot go for buyback. There are certain conditions given under the Companies Act. Only after satisfying those conditions, company can go for buyback. Without satisfying those conditions, company cannot go for buyback, and it is not a valid buyback. Okay, so what are the statutory provisions for a company for the purpose of going for the buyback? Okay, the company can buy back from where what are the sources it can use for the purpose of buyback? It can use free reserves, it can use securities premium, and it can use proceeds of any issue other than the shares which is going to for buyback. Okay, so these are the sources from where the company can go for buyback. And however, before going for the buyback, the company should verify their articles of association, whether there is a valid provision for the company to go for buyback. Okay, so what is the percentage? To what percentage the company can go for buyback? The maximum company can buy back 25% of paid up share capital and free reserves. Maximum how much the company can go for buyback? 25% of paid up share capital, free reserves. It cannot buy back all 100% equity shares. Okay, it can only go for 25%. In that 25% also, the company up to 10%. If the company want to buy back only up to 10% of its paid up share capital, in such cases, the company, it is sufficient for the company to pass a board resolution in the meeting. Okay, it is need not go for a general meeting. If the company want to buy back only up to 10%, it is sufficient for the company aggregate paid up share capital freeze, sufficient for the company to pass a board resolution. If the company want to buy back beyond 10% but up to 25%, then in such cases the company should conduct a general meeting, intimate the shareholders and pass a special resolution. Okay, understood? If the company want to buy back beyond 10%, then it is necessary for the company to pass a special resolutions. These are the main important provisions for any company before going for the buyback. Okay, so once after the resolutions have been passed, once after it gets the permission in the AOA, then it should file a copy of it to ROC, intimating the ROC that the company is going for the buyback. It should get legally valid permission from the ROC for the purpose of going for the buyback. And the company will buy back only fully paid up equity shares, but not any partly paid up equity shares. We have already, this particular point I have already mentioned in case in preference shares and in case of debentures, redemption of debentures. In case of redemption of preference shares also, the company will redeem only fully paid preference shares. In the same way, even in case of buyback of equity shares, the company will redeem only fully paid equity shares, and the debt equity ratio should not be more than 2:1. Okay, so how much is the debt the company have to maintain? The debt equity ratio, the debt equity ratio should be maintained either 2:1 or less than that, but it cannot go beyond 2:1. And within how much time the company will do this buyback process, madam? Means once after passing a resolution, within a period of 12 months, the company should go for buyback. Okay, so within the process of how much time? In the period of 12 months, the company should go for the buyback. And if suppose if the public limited company and whose shares are listed in the stock exchange, in such cases, it is mandatory for the company to also follow the provisions as specified in the SEBI rules and regulations. Okay, this is only applicable in case of a public listed company. Okay, now next, ma'am, once the shares are brought back, then what the company have to do? Once the company had bought back all these shares, the company should not store them. It should company immediately should destroy within a period of 7 days from the completion of the buyback process. Okay. So these are the main important points which the company have to do immediately after the process of buyback. Okay, they have to destroy them within a period of 7 days. And from where the company will go for buyback, madam? From where do they buy these equity? By where do they get back these equity shares? They can get back the equity from existing equity shareholders, that is from the open market, and the company can also get back the equity shares from their employees for whom these given as ESOPs and rights issue for the existing members. And from all these ways and means the company can buy back the shares. But what I have told you initially, if the company have to buy back, the company should say that it has surplus profits and the company is in solvency position before it, at least 3 years before the process of going for buyback. Okay, the company should be solvent, the company should have surplus profits, and the company should make all their statutory payments timely. All statutory payments should be made by the company. Okay, so what all the company have to make payments to income tax department or any other regulatory authorities, or in case of payment of gratuity, pension to the employees, and for the purpose of redemption, for the purpose of repayment of deposits, interest on deposits, and all these things, all these statutory requirement company have to fulfill before going for the buyback. Okay, so again, once the company in this particular year, the company went for the buyback, and again next immediately the company cannot go for buyback. It have to maintain a time period of 1 year from one buyback to another buyback. Okay, so these are the main points the company have to do before going for the buyback. Otherwise, the buyback would be considered as illegal or it is void. Okay, so ma'am, if suppose if the company had made any default in filing the annual returns or in repayment of the statutory provisions, or in repayment of deposits or paying for the statutory payments, in such cases the company cannot go for buyback. And first, immediately the company should correct its default. What did the company have to do? It have to correct its default, and after correcting its defaults, well, the company should wait for 3 years for the purpose of going for the buyback. Okay, so these are the main important provisions for the company need to follow before going for the buyback. And once the shares are bought, in next 6 months, the company should not again issue any type of equity shares. The main reason or main purpose of the company going for buyback is to reduce its equity shareholders. And again, going for the fresh issue does not make any sense, right? So the company should wait at least for 6 months for again going for the next issue of the equity shares. Okay, so these are the points you have to keep in mind before going for the buyback. And the company, as I have already told you, the company in general should not buy, other than the without fulfilling these requirements, if the company purchases its own shares, it is considered to be illegal and void. Okay, so these are the points relating to the buyback. Okay, next regarding the shares transmission of shares. Before saying this particular topic, so let us try to complete off this buyback. All the statutory provisions I have explained you. Very important examination theoretical question they'll ask, like in practical questions they'll ask, if the company goes for buyback up to 20% of their paid-up share capital free reserves, generally what resolution the company need to pass? It is sufficient for the company. Since it is more than 10%, the company need to pass a special resolution in the general meeting and take the approval of the shareholders. Okay, so this is in form of a bid. Other than this, the company can ask in form of a practical question, what are the sources for buyback, and and if the company is I mean, like if we want to go for buyback 30% of paid-up share capital reserves, is it valid? No, because it is exceeding beyond the statutory provisions told in the Companies Act. So you need to remember all these statutory points which I have discussed thoroughly before the company goes for buyback. Otherwise, the buyback would be considered as illegal and void. But however, for any banking companies and any other companies which gives loans for its customers, and if those customers indirectly purchases the shares of the company, you cannot call it as a buyback. Okay, in that cases. Otherwise, if the company want to encourage its employees and directors of the company and purchasing those shares on behalf of them, in such case you cannot term these things as a buyback. Okay, so these are a few points which you have to keep in mind. Next, what is meant by transfer and transmission of shares? What is difference between transfer and transmission of shares? I'll give you a clarity, then we will go for the provisional aspects. Please remember, what is the purpose of investing in shares for every public or for the individual? Why he invests in the shares of the company? Because it provides him easy liquidity. He invests his money in shares because it helps him for the easy liquidity. Whenever he wants his money back, he can immediately sell away in the open market. But when it comes to fixed assets like land and building, the selling of such properties takes some time. But in case of shares, we can easily sell, and once we sell, we will get that particular amount within 2 to 3 working days to our bank account. Okay, so in this particular case, transfer is in case of a transfer, registration of transfer is very important for the transferee or for the buyer to claim that he is the shareholder of so and so company. Okay, so registration is mandatory not for the transferor, it is for the transferee, because he can claim that he is the owner, and he will say, and he will have the share certificate in his hands. So this is a proof for the transfer of shares. Okay, so for that purpose, the particular shareholder and the transferor and transferee have to get this particular prescribed transfer deed form from the company and get it registered and pay the stamp duty on it and get it registered with ROC. Okay, in the sense, they will this particular transfer form is brought from the prescribed authority after stamping it. Stamp is important on that particular transfer deed, and all the details of the transferor and transferee are filled in this particular transfer form. Okay, so in this transfer form, what are details? Whose details are mentioned? Transferor's details and transferee's details. And the transferor, after filling all these details, they will sign on the particular transfer form. And this particular transfer form, in prescribed in the sense prescribed format given under the Companies Act. It should be in the prescribed format. And once this particular transfer form is received to the company, the respective authorities, in case of if the shares are fully paid up, those fully paid up shares, in such cases, automatically the transfer will be registered. But if the shares are not fully paid up, in such cases, if they are partly paid up, the prescribed authority of the company will issue a notice to the transferee asking him whether transferee is aware that the shares are partly paid up and is his financial position allows him to pay the remaining call value of the particular remaining value of the shares. Okay, this is only in case of partly paid up shares. The company will issue notice to the transferee asking him whether he knew this particular thing, that his shares are being transferred or partly paid up, and will he be able to pay the balance call money. Okay, if there are shares are fully paid up, then no notice is sent to the transferee, as the shares are fully paid up and nobody is liable to the company. Okay, and here one more point. Within how many days, ma'am, this particular transfer deed have to be submitted to the company? After getting this transfer deed being stamped by the prescribed authority, it should be delivered to the company within a period of 60 days. If after this period, if they deliver, the stamp does not have that particular validity, and the transfer deed validity will become void. Okay, so in such case, it is mandatory to transfer this transfer deed within a period of 60 days from the date when it is stamped and signed by the transferor and transferee. Okay, so once the authority confirms the transfer, registers the transfer, then immediately what is the next step? They'll take this particular register of members, strike away the name of the transferor and write the name of the transferee. Okay, so whose name they will strike away? The transferor's name will be removed from the register of members as the shares are being transferred to the transferee, and transferee's name will be written in this particular register of members. After that, the company will issue the share certificate in name of transferee within a period of 1 month from the date on which they received an application from this particular transferor or the transferee. Within how much time in case of transfer? Within 1 month from the date of application for registration of transfer, the share certificate should be transferred to the transferee in his name. Therefore, now transferee will be called as a member of the company. Who will be called as member of the company? The transferee will be called as a member of the company, and now he will get all rights to attend the meeting, to vote in the meeting. Okay, now ma'am, in this particular case, during this process of transfer, if company declares any dividend, okay, now the dividend either it will go for the transferor or the transferee. Okay, now what the time now for this time being, as per the agreement between the transferor and transferee, the dividend, the company in such cases transfers this dividend in case of pending registrations to the unpaid dividend account, and from there the company will transfer it to the transferee once the shares are transferred or registered in name of transferee. Okay, during this process of pending process, if the company declares a dividend, in such cases the amount of dividend will be transferred to the unpaid dividend account. From them it will be claimed by the transferee once the shares are registered in his name. Okay, so these are the important points in case of a transfer of shares. Now, madam, what is this transmission? What is difference between transfer and transmission? Okay, there is a difference between transfer and transmission. In case of transfer of shares, for the purpose of getting registration of transfer, it involves some cost element to the transferor, okay, or transferee. Both of them, any of them have to pay some cost for the purpose of registration of the transfer. Okay, suppose this have to be paid by the transferor. The expenditure is to be the seller have to pay the cost of transfer. If he claims from the transferee, later on he should reimburse the expenses to the transferee. So they need to pay the amount for the stamp duty for the purpose of registration of transfer. But in case of transmission of shares, such expenses are not involved. Automatically the shares are being transferred to the transferee. At what time, during what period this transmission takes place? Transmission takes place by operation of law in case of insolvency of the shareholder of the or the transferor, or in case of death of the transferor or the shareholder of the company or the member of the company. Okay, so transmission takes place because of operation of law. Okay, automatically the shares will be transferred to the transferee, that is to their legal hires or to any other person whosever name is specified. These are the important difference between transfer is voluntarily for some consideration. Transmission takes place because of operation of law, where there is no consideration between the transferor and the transferee. How in case of transfer, the stamp duty registration is mandatory, but in case of transmission, the transferee who got shares because of insolvency or because of death of a shareholder, in such cases the legal hire have two rights. What are those two rights available for him? Either he want to continue as a member, he should get it registered with the company, his membership, and second one, otherwise he can sell away that shares to some other person. So once he decides to get these shares registered in his name, again he should make an application to the company, pay the necessary stamp duty, and get the shares registered in his name. Okay, understood? Those are the two alternatives available in case of transmission of shares. Okay, so these are the main important points in case of transfer and transmission. Transfer is a voluntary act where consideration is involved. Transmission takes place because of operation of law, where there is no consideration between the transferor and transferee. Automatically shares are transferred. But if in case of transmission, you cannot call the transferee as a member until and unless he gets registered with the company. Only when he gets registered with the company, he will be called as a member of the company. Okay, so these are the important points relating to the transfer and transmission. Now let's come to the blank transfer. What is this blank transfer, madam? This is important for small like for bits of 1 mark or 2 marks. Blank transfer, in this particular case, shares are transferred from one person to other person without any kind of registration or intimation to the company. Okay, in this particular blank transfer, shares are transferred from one person to other person without any registration or without any payment of stamp duty or without intimating to the company. Initially, in this particular process, for example, I will tell. Initially, the transferor X will take the transfer form and fill all his details and transfer this to Mr. Y without getting registered. Okay, so Y takes this particular form along with share certificate and gives money to Mr. X. Now Y will transfer this particular transfer form, instrument of transfer form and share certificate to Mr. Z for some consideration. But in this particular process of transfer, there is no registration which is happened. Now Z want to keep the shares with him as a member of the company. Now what Z can do? Z can take that particular instrument of transfer form, fill all his details, give necessary signatures, and pay the necessary stamp duties as required, and file this particular copy within 60 days after paying the stamp duty to the company and get the shares registered in his name. Okay, from then in that particular case, the company will strike off the first transferor's name X from the books, and they will include the name of Z who wanted to get his shares registered in his name. And in this particular process, when the shares are transferred from X to Y and Y to Z, in this particular in the intermediate transfer, it is called as a blank transfer as there is no registration. Okay, so these are the important points relating to the transfer. Okay, blank transfer. Next, forged transfer. Remember, any transactions involving forgery are void ab initio. Okay, so this is a main principle which is applicable in Companies Act or Indian Contract Act or Negotiable Instrument Act. Okay, whenever the shares are being transferred from one person to other person, if the signatures of transferor or transferee are forged, in such cases, such transaction would become as a void ab initio. It is illegal and it is not valid. Okay, so another important thing which I have to explain to you, this particular case, in following cases, the registration of transfer would be refused by the company. Okay, in some cases, the company would refuse the registration of transfer. What are the cases when company can refuse the registration of transfer, ma'am? The public company and private company. In case of private company, the transfer will take place only within the members, as you all know, right? In case of a private company, the transfer will take place only within the existing members of the company. But in case of a public company, the transfer can takes place even with the outside the company, also with outside members and the public in general. But however, in some cases, the company will refuse the transfer when it thinks the transfer form is not properly filled or not the stamp duty have not been properly made. And in case of partly paid up shares, if the transferor's financial position is not good to repay the balance call money, or if the transferee's financial position is not good to pay the balance call money, nor the transferee does not know about these partly paid up shares. In such cases, the company might refuse to register the transfer. Okay, so these are the following reasons because why the company might refuse to register transfer. In such cases, the company will intimate the same both to the transferor and transferee, and if they are not satisfied with the reasons given by the company, they can go for further appeal to a tribunal. Okay, understood this particular point? The company will give his own explanations and own reasons for the refusal for registration or transfer. With these reasons and refusals, if that particular shareholder is not satisfied, or if the transfer is not satisfied, then they can go for an appeal to the tribunal within the prescribed time limits given under the Companies Act. Then whatever order passed by the tribunal is final. The order passed by the tribunal might be in favor of company, nor it might be in favor of this transferor or the transferee. Okay, so these are the cases where the company will refuse to register the transfer. Okay, sometimes in the register of members, if company have by default written the name of the transferee as wrong, written the name of that particular person as wrong, then if the transferee comes to know, he can intimate the same to the company for the rectification. Even after repeated reminders also, if company could not rectify the mistakes of the names of the particular transfer in the register of members, then the frustrated transferee can make an appeal to tribunal. Then the tribunal will give a notice to the company asking the company to immediately rectify the register of members. Okay, so these are the important points relating to rectification of register of members, which is important for general bits. Okay, who will order the company to rectify, even though the company after repeated reminders could not rectify the register of members with the correct name or correct spelling? In such cases, the tribunal will order on the request of the member to asking the company to rectify the name of the particular shareholder or the transferee within the prescribed time. Okay, so the last one is further issue of shares. What is this particular concept of further issue of shares, which is also called as right shares? Okay, this particular right shares option is given to existing equity shareholders. Okay, please try to remember this particular option is given for the existing equity shareholders. The company, before going for any before issuing these shares to outside public, the company, what it will do, it will issue to the existing equity shareholders and give them some time whether they can proceed with this particular offer, or if they don't want, they can reject it. Okay, there is no compulsory rule that the shareholder should accept this particular offer. Okay, if they want, they will accept, otherwise they will reject. In this particular of rights issue, the provisions relating to minimum subscription, minimum application money, opening separate bank account, everything would fall place. Okay, everything would come in this particular process of rights issue. Here the company should get the minimum subscription and deposit all the amount in this particular separate bank account before allotment of shares. All those points which we have discussed previously will apply in case of rights issue. And what is the difference between rights issue and bonus issue, ma'am? In case of bonus issue, company is freely giving the bonus shares to the equity shareholders without any consideration, but rights issue is not like that. In case of rights issue, what's an only advantage given to equity shareholders is that they would get an additional right. First the offer would be made to them, then only if they reject, only the company can go for offering these shares to outside public. Okay, that's the main difference between rights issue and the bonus issue. Okay, so with this we have completed this particular topic, and now we will go for the next topic relating to the debentures, deposits, and charge. We will deal in this particular topic. Okay, so for that, let's wait for Okay. Okay. So friends, let's start the new topic now. Debentures, deposits, and charges. Okay, this is the next important topic, which in this particular from this particular concept you can get roughly about like 5 to 10 marks in your examinations in form of bits and few practical case laws and few theoretical questions. And it's a very, I mean, like a minimum marks of 5 to 10, 8 to 10 marks would be asked from this particular topic. Okay. Now, until now, we have seen what is a share capital, what are the different types of shares, and what is for features, surrender, buyback, bonus issue, rights issue, and all those stuff. Okay. Now, we are seeing the next important topic is debentures, deposits, and charges. What is a debenture to a company? Debenture is a loan to the company. So, equity shares and preference shares is a capital to the company, but whereas a debenture is a loan to the company. Now, tell me one thing. When we ask a loan from a bank or a financial institutions, they will freely give you a loan, or they will ask you for some asset as a security, right? So before going for a loan, they would verify our credit worthiness, as well as they would ask for some security, as any assets. Do you have any assets? Then only the company, the banks or the financial institutions will offer such loans. But however, in this particular case, when company can raise debentures, or company can raise their loan by issuing debentures from its members or from the public, either secured way or in case of an unsecured mode also. In case of secured, if it's a secured debenture, the company in turn offering its asset as an security for the purpose of raising funds. But in case of an unsecured debentures, there are no assets as a security for the creditor. The debenture holder is called as a creditor to the company. They are the lenders to the company, whereas in this particular case, company is the borrower. Okay, so here debenture includes debentures, debentures, bonds, stocks, and any other instruments of the company. Okay, the term debenture is nothing but for this particular, once the company raise funds in form of a debenture, in this particular case, the company will also issue a debenture certificate after it allots debentures to those particular creditors or the individuals or the public, outside public. Okay. Now you can ask me one question. Ma'am, since debenture holders are called as creditors of the company, do they have any voting right in the meeting? In annual general meetings or in extraordinary general meetings of the company, the debenture holders does not have any kind of voting right. They will vote only in their class meetings. Debenture holders cannot vote in the general meetings of the company. Okay, so once these and they will generally the return on these debentures would be given by the company to the creditors in form of an interest. Okay, so on these debentures, the company would pay interest to the debenture holders, and it is a fixed percentage of interest. It is paid according to the terms and conditions before they enter into that particular contract. Okay, with company and the outside public. Now, the company in case of debentures also, they'll maintain a separate registers for debentures, and they will mention all the details of these debenture holders or the creditors of the company. Okay, so now they do not have the voting right. I am here now. As I have already told you, debenture is a kind of a loan and a burden to the company. There is, after a certain specific period of time, these debentures have to be redeemed by the company. We will see what is that particular specific period of time. Once the debentures are given to that particular debenture holders, the company would issue a share certificate within a period of 6 months from the date of allotment of debentures, or in case of transfer of debentures from one person to other person. In such cases, if such transfer is registered, the debenture certificate would be given within 1 month from the date of receipt of that particular instrument of transfer. Okay, so these are the basic important points relating to debentures. Now, what is the difference between share and a debenture? Now, share is nothing but a share capital for the company, but debenture is an acknowledgement of debt. It is a loan to the company. It's a fixed commitment to the company. Okay. So here, shareholders are generally treated as the owners of the company because they take part in the decision making. They take part in the management of the company. They have right to vote in the meeting by passing a special resolution or ordinary resolution. But whereas debentures are called as creditors to the company, they don't participate in any management decision making process. Not They does not have any voting right. And the shareholders have the they have the part in the profit sharing of the company. They have the right or a claim from the profit sharing of the company, where debenture holders does not have any claim over the profits of the company. Okay, so they just get the fixed interest out of for their investment in the company. Okay, the dividend paid on these equity shares, or the percentage of dividend, keep varying from one financial year to another financial year. But in case of debentures, the rate of interest is fixed. Okay, now when it comes to this particular charge on assets, since there is no charge on assets in case of shares, because shares are not they are not secured shares or unsecured shares. Since it is not a loan, there is no charge on any assets. But in case of debentures, there are charge on assets, because the loan is given by the public to the company for the assets which are given as a security. It might be in form of mortgage, pledge, or hypothecation. Therefore, charge is created on the assets of the company in case of debentures. So for shareholders, they directly or indirectly control the affairs of the company, but in case of debenture holders, there is no such control. Okay, so these are the few differences between the shareholders and debenture holders, share and debenture. Now, as we have already told you, types of equity shares. Equity shares with ordinary voting rights, equity shares with differential voting rights. In the same way, we have seen different types of preference shares. Now we are going to see this particular types of debentures. On the debentures are classified on the basis of priority, on the basis of negotiability, on the basis of redeemability, on the basis of security, and on the basis of convertibility. Okay, so on the basis of priority, we have first debentures and second debentures. On the basis of negotiability, you have bearer debentures and registered debentures. On the basis of redeemability, you have redeemable debentures and irredeemable debentures. On the basis of security, you have secured debentures and unsecured debentures. On the basis of convertibility, you have convertible and non-convertible debentures. Ma'am, what is this first priority and second priority debentures, ma'am? Ma'am, in case of first priority, they are specific, they are classified in this particular case according to them, according to this first priority debentures. They are repaid first before making any payment to second priority debentures. Second priority debentures are repaid only after paying to first priority debentures. Okay, on the basis of negotiability is nothing but transferability. When the debentures are transferred from one person to other person, they get registered. They are called as registered debentures. If they don't get registered, if they are freely transferable, then they are called as bearer debentures, because there is no registration is done. They are freely transferred from one person to other person. Next, on the basis of redeemability, as I have already told you, after a fixed period of time, as per the terms of agreement, it may be 2 years, 3 years, or 5 years, maximum up to 10 years, the debentures have to be redeemed. Irredeemable debentures are those debentures which are not redeemed, but what they happen, they will get converted into equity shares after a certain period of time. Okay, so on the basis of security, the debentures for which they are secured and for which the security or the assets of the company are charged, those are called as secured debentures, and which are not charged are called as an unsecured debentures. Okay, so these are important points relating to the types of debentures. Now, ma'am, who are these debenture trustees? Why do company need debenture trustees? I will tell you this particular point. First, let me explain these trustees. Okay, any company which want to borrow some money from outside public, the public should have trust in that company. Then only they will give a loan. See, for example, if we want loan, if we go to a financier or to our family member, if we ask for some loan of 5 lakhs or 10 lakh rupees, do they directly give us? Only when they have trust in us, only when they know us, or when our father or any other person gives some guarantee, then in the third party will give us the loan. In the same way, in order to create a trust among the public, the company will create the debenture trustees like an agents or they are nothing but the debenture trustees are the representatives on behalf of the public to represent them in the company. Okay, only then the company could get more loan from outside public if they establish this particular debenture trustees. Debenture trustees are nothing but the representatives and agents on behalf of the public to represent them in the company. What are the main responsibilities of these particular debenture trustees? They will ensure that company is utilizing the funds for what they have mentioned in the advertisement or in the prospectus. For what purpose they have borrowed this particular money, for the same purpose they are utilizing the money properly. And they will also check whether the secured assets, the assets which have been charged, are not being sold by the company without the permission of the charge holders or without the permission of the creditors. And they will also see whether the company is timely repaying back the interest and repaying back those debenture holders, redeemable debenture holders. Okay, so these are the duties of the debenture trustees. If they get any sort of negative information from the company, or if they think that company is selling away the securities without intimating to the debenture holders or not repaying properly their interest, immediately they will make complaint on behalf of the public or the creditors or behalf of the debenture holders to the tribunal against the company. Okay, so if they fail to do so, in such cases the debenture trustees would also become personally liable along with the company to the creditors or to their debenture holders. Okay, so these are the main responsibilities and duties of the debenture trustees. And they should also see that, ensure that company is conducting timely the class meetings with the debenture holders and intimating all the necessary informations or changes that takes place in the company which are related to them. Okay, so before when this company will appoint debenture trustees, ma'am, debenture trustees are appointed before the company goes for the asking for the loan from the outside public. Before making an offer to the public, then only they will create this debenture trustees, and their names and details would also be mentioned in the offer letter or advertisement or circular where the company want to raise funds or accept loan from outside public. And the debenture trustees is mandatory in the case when the company is going for issue of secured debentures and issue of debentures through a prospectus offer letter made to public or to existing members exceeding 500. If the company, in that particular company, if number of members are exceeding 500, in such cases the company, it's mandatory for the company to create debenture trustees and mention their names and details and their consent in the prospectus before going for such issue. Okay, so disclose all their names. And who will appoint these debenture trustees? The board of directors themselves will appoint the debenture trustees. Okay, so I have already, and this, what are the disqualifications? This is also an important disqualification of the debenture trustees are they should not be any beneficial holding of shares in the company. The debenture trustees should be completely an independent persons. Okay, they are independent person. They are not directly or indirectly related with the management of the company. Okay, so these are the points which you have to keep in mind. Okay, they are not the persons who are directly or indirectly related with the company. Those are completely independent persons. They are not any key manager persons or employee of that particular company or its holding or subsidiary or associate company. They should not beneficially hold any shares in the company. They should not give any loan or guarantee to the company. Only such persons will be appointed as a debenture trustees by the board of directors, who will independently take decisions in favor of the public and protect their interest. Public in the sense here, the debenture holders and the creditors of the company. Their main duty is to protect the interest of debenture holders and creditors who have given loan in form of debentures to the company. Okay, these are the very, very important aspects for debenture trustees. Duties of debenture trustees, I have already told you. Their duty is fiduciary duty because they are acting for the sake of debenture holders or the creditors of the company. Their responsibility is to protect them, save their interest, and to ensure them that their interest is being properly paid and ensure them that the company is properly utilizing the amount. Okay, if they get any negative information about the company, or if they think that company is deviating, immediately they should intimate to the tribunal. Okay, so these are the points duties relating to the debenture trustees. And this particular trustees concept is similar or same even in case of deposits. Okay, deposits is also a kind of loan given by the public to the company, and in that particular case also deposit trustees are important, and these trustees have the similar roles and responsibilities even in case of deposits. Okay, so with this we complete this particular topic of debentures. Now next up, let us start this topic of deposits. Before starting this particular topic, what is a deposit, ma'am? What is a deposit? Deposit is a kind of a loan borrowed by the company either from its existing members or from outside public. Okay, so what is deposit? For every general, I mean, like in the sense, for a common man to understand, deposit is nothing but it includes receipt of money from the existing members or from outside public in form of loan to the company. Therefore, deposit holders are also creditors to the company. Who are they? They are also creditors to the company. And for this particular deposits, the company in return would give them some fixed interest. Okay, what the company would give? Company would give them interest. And the rate of interest, what is the rate of, in what rate of interest the company should give them on their deposits, ma'am, is the rate of interest which is timely declared by the RBI. Okay, so RBI for NBFCs, whatever rate of interest they have declared, that same rate of interest can also be implemented by the board of directors of the company for repaying to these deposit holders. Okay, now in this particular case, you have to you remember a few points that deposits is nothing but a loan which is given by the company, loan which is given to the company either by the member or from an outside public. But the following are not considered as deposits. Any amount the company receives from the government, foreigners or foreign government, and loans from a banking company, loans from public financial institutions, loans like through mutual funds, venture capital funds, and on commercial papers, intercompany transfers, on amounts received as share application, amounts received from the directors, like a startup subsidies and initiatives given to the companies, amount received through bonds and debentures, amount received from an employer security deposits, amount received on trust, amount received on supplies or advances and security deposits, etc. for the company, or unsecured loans or secured loans from promoters of the company, or amount accepted by the Nidhi company, chit funds. All these are not considered as deposits. The following things which I have mentioned, please go through them in detail in your materials, where these are not considered as deposits and you cannot call them as a deposit, and you need they will follow their own statutory rules, and these Companies Act rules are not necessary for them to follow. Okay, now who can accept deposit? Generally, a public company, there are two types of public companies, public companies and listed public companies. Here in this particular case, you have another concept called eligible company. Who will fall in this particular category of eligible company? This eligible company can claim these deposits from both members as well as from outside publics. Other than eligible companies will claim the deposits only from its existing members. Even private companies will also claim the deposits only from existing members. You already know that there is a restriction in the articles of a private company where private company cannot accept deposits from outside public. It can accept deposits only from its existing members. In the same way, other than eligible company will also accept its deposits from existing members, but eligible company can accept from both members as well as from outside public. When a company can become an eligible company under section 76 is such companies having net worth not less than 100 crores or turnover not less than 500 crores. Here remember, either net worth not less than 100 crores or means any of the two you can satisfy, or turnover not less than 500 crores. In such cases, the company is called as an eligible company, where it can accept deposits from outside public, but only but such companies, before accepting the deposits from outside public, it should check whether it have this provision in AOA of that particular of the company books, and it should also take the prior approval of the shareholders in the general meeting by passing a special resolution. Okay, Okay, so what resolution here the company have to follow before accepting deposits from outside public? What resolution? Special resolution. And the same, after passing a special resolution, the same thing company have to intimate it to ROC. Okay, whom the company have to intimate? ROC. Ma'am, here eligible company, if it is accepting deposits within the limit specified under 180, in such cases it is sufficient for the company to pass an ordinary resolution. What are the limits specified in section 180? They will not ask you, because this particular point is covered in your final syllabus. Okay, generally, as per the syllabus which is covered for you, here it is sufficient if the company passes special resolution before the eligible company may accept deposits from outside public. But if that particular same eligible company accepting deposits within the limits specified under section 180, then it is necessary for it to pass an ordinary resolution. Okay, so here sometimes this particular rules are not applicable. Rules and sections are not applicable for these type of companies like banking companies, non-banking financial companies, housing finance companies, and companies which are specified by central government, because they, in those cases, in relating to deposits, their duty, the main purpose of these banking company, non-banking financial companies is to accept loans and give loans to the outside public. For them, they have their own statutory act, which it is sufficient for them to follow the provisions of that particular statutory act. These deposits rules are not applicable for these companies, therefore these are exempted from these sections and rules of deposits. Okay, now I have already told you the eligible company can accept its deposits either from existing members or from outside public. Okay, other than eligible companies, other than the public companies can also be other than eligible companies, no, and the private companies are other than eligible companies, no. If such companies are accepting deposits from its members, the following conditions have to be satisfied. Okay, so what are the conditions they have to satisfy, ma'am? Initially, in such cases, they need to pass a circular. Here the company will not give advertisement, because advertisement is given through newspapers in general. Here, since they are not asking outside public, it is sufficient for the company to pass a circular. Okay, and in this circular will contain all the details, how terms and conditions, rules and regulations relating to the deposits, how much amount they want as a deposit, and what's the total time period of the deposit and rate of interest. Okay, and next one is what the company, before accepting the deposits from members, they have to pass a resolution in the general meeting. And if that particular deposits are secure deposits, the company can also give an assurance that they appoint the trustees. Every year the company have to ensure to see that at least before 30th April of each year, it should at least transfer 20% of the amount of deposits which are maturing in the next financial year into separate bank account, that is called as deposit repayment reserve account. Here once again I'll tell you this particular point. And suppose if the company, for example, in the year 20 and 21, in the financial year 20 and 21, if the deposits are maturing around 50 lakh deposits, so 50 lakh deposits company have to pay back to these deposit holders. In such cases, in the financial year 2019 and 20, the company should see that at least 20% of these 50 lakhs amount is transferred to separate account maintained by the company, that is called as deposit reserve account, repayment reserve account. And this amount should be utilized only for the purpose of repayment. It is nothing but the company saving some amount initially so that it will be ready to repay that particular deposit on that particular respective due date or a maturity date. So in case if the company is accepting deposits from existing members, it is sufficient for the company to give a circular to its members with all necessary details, and afterward the same circular with all the necessary details, the company should file it to ROC and intimate him that particular, intimate him the same, that the company have accepted the deposits from outside, from the existing members. If the company is accepting deposits from outside public, this particular provision, this particular rule under section 76 is applicable only in case of eligible companies, because it is accepting deposits from outside public. See, listen one thing, students. If in this particular case, since it is accepting the deposits from outside public, the company should be careful in whatever information they provide in the advertisement, because it should give a true and fair information about the company to the public. They should not cheat public by giving a wrong and falsified information. So they should be careful while giving the information, and they should also ensure that the company would get the credit rating from credit rating agencies, so that basing on this particular credit rating, the public would decide whether to give deposit or whether to invest in that particular company in form of deposits or not. And companies should also specify if they have made any defaults in repayment of deposits previously, and they should also give confidence to the public that there is no pending repayments, or the company did not make any default at the time of repayment. Okay, so these are the important things which the company should keep in mind before going for the public issue or before accepting deposits from the public. And if they have created any charge or given any asset as a security for the purpose of borrowing money from outside public, all necessary information relating to the asset and relating to the creation of charge should also be mentioned in an advertisement as an intimation to the public, because on basis of all this information, the public will decide, the public will think whether it is correct or right for us to invest in that particular company. They will make an analysis on seeing that particular advertisement. This advertisement will be given by the company in one vernacular language of that particular state, or and compulsorily in an English newspaper. Vernacular language means local language of the particular state where the register office of the company situated. Okay, so these are the important points relating to acceptance of deposits from outside public. Okay, now next very important point. Ma'am, what is the time limit for the secure deposit? You have specified what's the maximum time limit for the purpose of preference shares, where the company can go for redemption once after that particular period expires. The same thing even in case of debentures, and now in case of deposits, what is the maximum time limit in case of these deposits? Okay, the company will accept the deposits from a period of 6 months to minimum 6 months to 36 months. Okay, yeah, the note and this particular time limit in general, in the sense like a minimum period of 6 months have to be maintained, the life of the deposit, and to the maximum of 36 months. After the 36 months, the company will repay back. After the maturity period, it might be 6 months, 7 months, 8 months, 1 year, whatever the time as the case may be. Okay. However, sometimes companies for short-term purpose, remember students, it's very important point. Sometimes for short-term purposes, company will accept deposits for a life which is less than 6 months, for the maturity period which is less than 6 months. Okay, in such cases, the company will do repayment only after completion of 3 months. Okay, remember on this particular point, the company can accept deposits, those are called as short-term deposits, for a maturity period less than 6 months, where repayment will be done only after 3 months. Such requirements can also be met by the company, but however, the acceptance of such deposits should not exceed 10% of aggregate paid-up share capital, free reserves, and security premium. To what percentage the company can accept such kind of deposits for a period lesser than 6 months, and the repayment is made only after 3 months? In such cases, the amount of deposits should not exceed 10% of aggregate paid-up share capital, free reserves, and securities premium account. Okay, so these are the important regarding the period of deposit. Now, next, very important, maximum how much amount the company can claim deposit, ma'am. Here, remember all the eligible companies for whose the criteria we have satisfied earlier. These eligible companies can accept deposits maximum to the extent of 35% of paid up share capital and free reserves and securities premium. Maximum how much they can claim the deposits? 35% of paid up share capital and free reserves. But however, there is bifurcation. Ma'am, these eligible companies can claim up to 10% of aggregate paid up share capital and free reserves from their existing members, and up to 25% from the outside public. Okay, this the bifurcation is given for the eligible companies. Up to 10% is from existing members, and more than 10% up to 25% is from outside public. But however, in case of public companies and private companies which are accepting deposits from only members, in such cases the entire 35% of paid up share capital, free reserves, and securities premium can be claimed only from their existing members. Okay, the entire 35% can be claimed from existing members. However, there is some exemption in case of specified IFC public companies and private companies that 100% of aggregate paid-up share capital free reserves can be claimed as deposits, and the same should be intimated to ROC. Okay, but in case of government companies also there is no bifurcation. The maximum ceiling limit is 35% of paid-up share capital and free reserves and securities premium. They can claim either from the members or from the outside public. Okay, that is in case of a government eligible company. This is for government eligible companies. Okay, but however, in case of a private companies, which is a startup private company and which is not associate or substitute or a holding company, in such cases for that such private companies, this particular limit is not applicable. Okay, so these are the maximum amount. Now once again I'll tell you, for an eligible company, the maximum amount of deposits should not exceed 35% of paid up share cap free reserves. Free reserves include securities premium account also, and here there is bifurcation. Up to 10% is from its members and about 10% is from its non-members, that is from outside public. But however, in case of private companies and from for public companies who does not come under the definition of an eligible company, can claim this 35% entirely from its members only. Okay, so these are the important points. Now, ma'am, what is the interest and brokerage? Interest is nothing but here how much interest the company is responsible to pay to its deposit holders, and in case of brokerage, how much brokerage the company would pay to these brokers who have bought the deposit holders to the company. Okay, here what the Companies Act is saying is the rate of interest or brokerage shall not exceed the maximum rate of interest or brokerage prescribed by RBI in case for the acceptance of deposits by non-banking financial companies. Like how non-banking financial companies will accept such deposits. In the same way, for what is the rate prescribed by RBI, the same rate is also applicable even in case of companies which are accepting deposits from outside public. Okay, so this is an important or a very small point which you need to remember. Okay, now next, very important, this particular part is asked generally from examinations theoretical perspectives. What are circulars and advertisements available? Okay, remember circulars and advertisements, what are the contents of the circulars and advertisements which is necessary for the company to prepare when the company is accepting deposits from the members and from its outside public. Okay, remember, as I have already told you, circular is generally given by the company to when it is accepting deposits from the members. Okay, so when it is accepting deposits from the members, the circular is given. But advertisement is the term advertisement. We use the term advertisement when the company is accepting deposits from outside public. Okay, now this circular or advertisement should be in form number DPT1. In which form it have to be? DPT1. And what are the contents of the circular and advertisement? Generally, the financial portion of the company will be discussed in it, like giving the previous year's financial statements, P&L accounts, credit rating obtained in case of eligible companies where the company is accepting deposits from the outside public. Credit rating is also obtained from credit rating agencies, and a total how many number of depositors are there, and other particulars relating to is there any amount due which have to be paid to the deposit holders by the company. All this information are the contents of the circular or the advertisements. Okay, now this particular advertisement is issued by an authority of the company, it's board of directors of the company, or they can delegate this power to specific authority for the purpose of issuing circulars or advertisement. Once a circular or advertisement is prepared by the board of directors, they should deliver it to ROC. See, whatever the company do, they should intimate the same to ROC within 30 days. Okay, and get the legal permission from ROC. Once this advertisement is given in the vernacular language newspaper or an English language newspaper in the state where the register office of the company is situated, it is valid for a period of 6 months from the date of closure of financial year in which it is issued, or date on which the financial statements are laid in the company's AGM. When there is no AGM, the last date on the meetings it would have been held. Okay, so in the earliest date, so this particular advertisement is valid earlier of these particular date, 6 months from the end of the financial year, from the closure of the financial year, or the day on which the financial statements have been laid before the AGM, whichever is earlier date. Until then, this particular circular or advertisement is valid. Until then, the company can collect its deposits until it reaches to the maximum limit of 35% of paid up share capital, free reserves, and securities premium. Okay, so now, in this particular circular or in the particular advertisement, the company, for the company, the statutory auditor of the company, statutory auditor means whom, the auditor who every financial year who conducts the audit for the company should give a declaration in prescribed form saying that company have not committed any offenses or any defaults in repayment of deposits to outside public, or in repayment or timely repayment of interest on those particular deposits. Okay, and if suppose the company had made a default or made a mistake, the company has immediately corrected it. Okay, that particular assurance should be given by the statutory auditor. He should give in form of a certificate to the company in prescribed form, and that certificate should be mentioned in the advertisement or the circular when the company is going for the accepting deposits from the outside public. This certification should be, the company should get this particular certification from the statutory auditor regarding the regarding whether the company had made defaults or not, or whether the company is making timely repayment of interest to those deposit holders, and if suppose the default have been made, if that such default have been corrected or not, all those details the company should specify. The statutory auditor will certify this, and the same is also intimated or informed in the advertisement or the circular of the company. Okay, now this particular circular is given to the, for the existing member, circular how they will send the circular, either form of registered post or acknowledgement due, speed post, or in electronic mode, or give a publication in the newspaper, or also same thing, they would also place this particular circular in the website of the company. In this particular advertisement in the newspaper, if the company is accepting deposit from outside public, in such cases the advertisement will be given in the newspaper, and the same also will be uploaded in the company's website. Okay, circular will be given, sent through post personally, and in this advertisement it is given in the newspapers, and also both things are also updated in the website of the company. Okay, so okay, now this particular advertisement has reached to the outside public in general. Now public want to, some public are interested in the company because they think that they are getting the better rate of interest than the rate of interest where they would get on fixed deposits in a bank. They would get a better rate of interest. Generally, people would incline towards it, and people would like to invest in such companies. No, in such cases, the public who are interested to accept the deposits to give money to the company, they will ask for an application form. They would request the company for an application form. Then the company would give this particular application in prescribed form to these deposit holders, and that they can also purchase the deposits in joint names also. Okay, single person can purchase the deposit, or they can also purchase in the joint names, and they can also mention in that particular application form there are details of nominees, where they will also include the details of nominees. Here one important point, they can also nominate a minor. Okay, and the joint holders can also keep a single nomination, or they want to have separate nomination, they can give two nominations. Okay, so these are the important points relating to nominations. Once the company receives the deposit, in this particular case of deposits, company will not give a certificate. In case of debentures, we have seen that company will issue a certificate. In case of preference shares, we have seen that company will give a certificate. In case of equity shares, we'll see that company will give a share certificate. But in case of deposits, once the company receives the deposits from outside public, it will issue a deposit receipt. What it will issue? Here you will not use the term certificate. Here it is mandatory for you to use this particular term called as receipt. The company will issue the deposit receipt within 21 days from the day on which it have received the money in form of cash or in form of check. From that particular date, the company will issue within 21 days the deposit receipt to the deposit holder, and it will enter all the details of this deposit holder in the registers maintained by the company, which is called as deposit register. Okay, this will be this, but every company, after accepting the deposits from outside public, at its registered office, it will maintain the register for these deposit holders. Okay, and this registered shall be preserved for a period of 8 years or more. Okay, for how many years it have to be minimum preserved? For a period of 8 years, the company have to maintain this particular register. And before depositing in the company, any person can come and inspect the deposit holders if they want to see check whether the name is entered in the register. They can come and inspect this register at the register office during the business hours of the company. Okay, so these are the very important points. If company fails or if company does any mistake in following these particular deposit rules specified in the Companies Act, in such case company and its officers are liable for penalties as specified under section 73 subsection 3 of the Companies Act. Okay, now here these are other few important points which I'm going to tell. If the particular deposit holder, the company is planning to repay these deposits or premature repayment of the deposits before its expiry period. Suppose the life of that particular deposit is 8 months. If the particular deposit holder is claiming back his money, or if the company is repaying before this 8 months, in such cases, the company would reduce 1% out of total interest payable to the deposit holders. If the deposit holder want to take back his deposit prematurely before the maturity period, how much the company would reduce at the time of repayment of this premature deposits? The company would reduce, suppose if it is for 12%, the company would reduce 1% and give the 11% as an interest on those premature repayment of deposits. However, in the following cases, the company should not reduce that 1%. What are those cases? In case the company is providing war and risk benefits to the personnel of Navy, military, Air Force and their family members, in such cases, the company should not reduce this 1% even though they are prematurely taking away the deposits from the company. That 1% should not be reduced. Very important point which you have to keep in mind. Next, suppose if the deposit holder want to renew the deposits prematurely before expiry of the term. Okay, suppose the term of that particular deposit is for example, it is 8 months, and he want to renew this particular deposits into another deposit immediately after 6 months, that is before expiry of the period. Yes, he can renew. He can jump into another type which is issued by the company, because if he said the interest rate given there is more when compared to the previous deposit. Why the shareholder we want to jump into another deposit and premature closure of the previous deposit? Why means if he feels that interest rate is more, in such cases what he will do, he will accept the new one and he will prematurely take away the old deposit, right? In such cases what the company will do is, yes, company will prematurely terminate the old deposit by reducing 1% interest out of the total interest payable to that particular deposit holder, and it would grant the new deposit with a higher rate of interest. Okay, so in that case, renewal of the deposits for the higher rate of interest is possible. And for that particular thing, the previous deposit could be terminated at a rate 1% reduction from the total interest payable. Okay, so these are the very important points relating to deposits. Until now, we have seen what are debentures, what are deposits. Both are like a loan given to the company, either from its existing members or from outside public. And we need to necessarily see here the definition of eligible company, which is very important, and what are the maximum limits the deposits can be accepted by the company, and what are the provisions applicable to the eligible company. These points you have to keep in mind. Okay, so one more important point I'm telling you, students, please listen. When you are writing an exam, especially law exams, if you're thorough with the section numbers, please write those section numbers correctly. Otherwise, don't try to write. You are writing the concept correctly, but when you quote wrong section number, it would become entirely wrong. Okay, so try to quote correct section numbers. Otherwise, try to avoid those section numbers, or you be thorough with few important section numbers. These are small mistakes students do while writing the examination. And when you're writing especially practical questions, you should also be careful when you're writing the provision and the concept. The provision, the correct inputs, and the provision, whether you are passing a special, ordinary, you should be thorough with all those things and write the correct one. You cannot change according to your will and wish. You need to mandatorily follow the statutory provision given under the Companies Act. Okay, so these are. And when it comes to the theoretical question, what I suggest the students is, instead of writing paragraphs and paragraphs, try to write in point wise and try to highlight the important points so that it will be easy at the time of valuing your paper. Okay, this person knows this particular answer. He have given the value inputs to that particular answer, and important points have technical words and technical points have been quoted. So all this judgment will be made by the valuer, and he would give a better marks. Okay, so these all things you need to keep in mind when you're writing a theory paper. And one more last important tip is, please try. Most of the people do not focus on their writing skills. Okay, they generally write away. And for them, you know what? One more problem will come, ma'am. For us, time is not sufficient time, so we wrote fast. See, whether you write fast or you write slow or whatever pace you are comfortable, but you see the words are easily understandable, or the words you can read easily, because it is not just sufficient you understand your words, it should be understood by the valuer, the person who is correcting your paper. If you write a B, and if the person can't understand that as a B, it will be difficult for them to frame the word, right? So write the words clearly and write legibly. Beautiful handwriting is not necessary here. Writing clearly and legibly is more important, because it should be understandable form for the valuer. So please keep all these points in mind, especially writing all the theory papers. Okay, so next, the last concept for this today's class session is charge. Okay, what is charge? What are the types of charge? Why the company creates charge? Charge is nothing but when a company borrows loans, either from banks, financial institutions, or from outside public. Generally, nobody, tell me one thing, who will give for you loan free? If you want some money, huge money in form of loan, that is the amount might be in some lakhs or crores, who will give you free? Does they have any guarantee that you will repay? I mean, even if you tell in your words so confidently that I would repay it after so and so period, confidently, but can anybody believe us when we say that? No. So in order to create belief or trust to the lender, it is mandate. Sometimes it is important. So even the banks also will not give any loans without any mortgage, pledge, or hypothecation. Charge is nothing but mortgage, pledge, or hypothecation. So it is mandatory for us to give some security of the assets we possess for the purpose of borrowing that loan. Okay, and giving that security, giving the asset as a security is called as a charge. Okay, what is charge? Charge is nothing but you are giving your asset as a security for the purpose of borrowing money. Okay, now in this particular case, this charge is very important in case of debentures and deposits. When the company is borrowing money from the outside public or from its existing members or from any banks or financial institutions, when the company offers its assets as a security and borrow money, it means that it has created a charge on those assets. Okay, who is this? Who will be this charge holder? The person who is lending the money. It might be a debenture holder, the creditor, or a deposit holder, or a bank, or a financial institution will be called as a charge holders. Okay, they are called as charge holders, lenders, or creditors, for whom the creation of charge is very, very important. And it is not just sufficient for the company to create a charge or come into an agreement between the creditor and the company, but registration of charge is important for the lender more than the company. Okay, just creating charge is not sufficient. What is important here? Here in this particular case, the registration of charge is important for the lender or the for the lender or the creditor who have given money as a loan to the company. For him, it is important for registration. Therefore, the charge have to be registered by the company within prescribed time in the prescribed form with the ROC. And keep that particular, because once the charge is created and registered, the public will come to know, okay, fine, on this particular, for this particular company, these many charges are there. Company have this much of borrowings and gave so much of money as a taken so much money and borrowed so much money as a loan from outside public or from banks or any other financial institutions. Okay, so it is that it indirectly registering the charge indirectly gives information to public, whoever is coming into contact with the company, to read this particular particular information thoroughly, and then only give loan or give loan or money to that particular company. Okay. Now, this particular charge is created by the company on its assets. The asset might be a fixed asset or a floating asset. See here once again the important definition which is given under section 2, subsection 16 of the Companies Act. Charge means an interest or a loan. Charge means an interest or a lien created on the property or the assets of the company. Okay. So, which also includes mortgage. Here, charge also includes mortgage. Okay. So, what is charge? Charge means an interest or a lien created on the assets or the property of the company, and it also includes a mortgage. Okay. So, here charge might be created in India or outside India, on the assets which are there in India or outside India. Properties might be in India or outside India. Okay. The properties might be tangible properties or intangible properties. What are tangible properties which we can see and touch are called as a tangible properties. What are intangible properties which we can't see, like goodwills, etc. Okay. So those are called as intangible properties. And here charges are created on the fixed charge and floating charge. Fixed charge is nothing but charge which is created on the fixed assets of the company is called as a fixed charge, and the charge which is created on the floating assets of the company, that is stock, debtors, is called as a floating charge. Very important, students, you have to remember. Like if some company gives a security as in land, buildings, for on which the charge is created, that is called as fixed charge. And if the company have given its stock, the entire stock, debtors, etc., those are called the property which is keep constantly changing is called as a floating charge. Ma'am, what is difference between fixed charge and floating charge? If in case of fixed charge, company cannot deal with the property without the permission of the charge holder, lender, or the creditor of the company who have given that particular loan to the company. Company cannot deal with the asset. But however, in case of floating charge, company can nicely use the stock, sell the stock, get the money and pay back the loan. Company can deal with the assets, but in case of fixed charge, company cannot deal with the assets. Okay. And fixed charge cannot be converted into a floating charge. There is no conversion of fixed charge and floating charge is not possible. But however, a floating charge can be converted into fixed charge, which is called as a crystallization of the floating charge. Okay. In this floating charge will be converted into a fixed charge. Okay. But however, conversion of fixed charge into floating charge is not possible. Ma'am, in what cases, in what instances the floating charge will be converted to fixed charge, madam? The floating charge crystallizes and becomes into fixed charge when company goes into liquidation, or when company ceases to carry on its business, or when debenture holders take steps, then when the debenture holders feels that the company is going into winding up, or company is not repaying back their interest and not redeeming their debentures. In such cases, these debenture holders can make the floating charge into a fixed charge, where company cannot deal with the stock without the permission of the charge holders. Okay. So this is very important 2 marks concept, crystallization of floating charge into fixed charge. Okay. Here, what is meant by postponement of floating charge? This is also very simple and easy. When this particular floating charge is created on one particular asset, that is stock or trade debtors, and in such cases on the same property there is another fixed charge created by another creditor. In such cases, this floating charge payment will be postponed, and the first payment will be made to this particular creditors who have created fixed charge on the same property on which the floating charge have been created. Who would create that fixed charge? Means the landlords for whom the company is not paying the rent properly, the creditors, the employees of the company for whom the company is not paying their statutory dues or payments, or supplier of the good. These persons, what they can do, they can create a fixed charge on the same property on which the floating charge have been created. So what it will happen means, at the time of winding up, the company first should make the payment to these fixed charge holders, then only the payment will be made to the floating charge holders. That is why they say that postponement of floating charge had happened in this particular case. Okay, so this is all about crystallization of floating charge and postponement of the floating charge. Now next come to the registration part. This is very, very important and crucial. Okay, I told registration of charge is very, very important for the persons, for the lenders or the creditors who are giving money to the company. Okay, for them, if suppose the registration company have just created the charge, and if company forgets to create make a registration, it is mandatory to remind the company to follow up them and to see that the charge have been properly registered with ROC. Okay, every company who is creating charge should register the charge with ROC in 30 days in prescribed form number CHG1 for other than debentures, and in case of debentures it is CHG9. Okay, and this particulars of this particular charge should be signed by the charge holder as well as the company, and the borrower and the charge holder, the lender, both of them should sign this particular instrument. Okay, and it's very, very important for the registration, because it is important for the charge holder as a lender for it to get it registered in time. Okay, here sometimes the company has the act as specified the time limit for the registration of the charge, and sometimes previously for the charges which are created before 2019, the center, with the permission of central government, the time have been extended to 30 days to 300 days for the purpose of registering of the charge. In such cases, the company have to pay some additional fees. And for the charges which are created after the commencement of 2019, in such cases, the time limit have been increased from 30 days to 60 days from the date of creation of charge with the additional fees. Okay, so these 2 points you please keep in mind, the time limits for the purpose of creation of charge. Okay, suppose if the company defaults to register the charge, who will be the sufferer? Who will suffer? The charge holder will suffer, because his asset which have been charged become an unsecured loan in the time of winding up of the company, and he cannot claim over the asset of the company. Therefore, it is mandatory for the charge holder to see that whether the charge have been properly registered or not. Okay. Once the charge is registered, the certification of charge is a proof to the public or the charge holder or the lender to show that his loan is a secured loan. And at the time of winding up, generally liquidator is appointed, and payment will be made to whom? First, to the secured creditors. Therefore, he can get the payment from the liquidator first if that particular charge have been created and registered in his name. Okay, satisfaction of the charge. What is meant by satisfaction of the charge is nothing but once after the charge have been created, if that particular loan amount is totally discharged by the company should intimate the same to the charge holder as well as to the ROC, and the company will ask the charge holder whether he is satisfied with the entire payment, and the same is intimated to ROC. Then ROC in turn will ask the charge holder whether he received the payment in full or not from the company. Only when he get the no objection letter, only when the ROC get the no objection letter from the charge holder, then the ROC will write the memorandum of satisfaction in the register maintained by the ROC, and he will strike off that particular charge details in his register, and he will give the satisfaction of charge memorandum of satisfaction to the company, that the company have completely fulfilled the loan amount or completely satisfied the charge holders. This is called as satisfaction of charge and memorandum of satisfaction, which is given by ROC to the company on satisfaction by the charge holder that he received the complete payment from the company. Okay, so and the same have to be intimated by the company to ROC. If suppose if the company forgets to intimate that it had made complete payment to the charge holders, and if the ROC comes to know about it from any third party or from any other person, in such cases also the ROC will look into the matter thoroughly and give the memorandum and intimate to the company and give a memorandum of satisfaction to the company and strike off the name from the register maintained by the ROC, that company have completely made its full and complete payment to the charge holders. Okay, so in this way, these are the important topics which you need to keep in mind, especially in case of charges. Okay, what is charge? What is meant by fixed charge and floating charge? What is meant by crystallization of the floating charge or postponement of the floating charge? And time limits for the registration of charges is also important. And what are the details to be filed to the ROC? What is called a satisfaction of charge and memorandum of satisfaction. Okay, and here one more important last point I need to tell you. If once once the charge have been registered with ROC, if the company want to make any corrections or want to make any adjustments or want to rectify some information related to the charge, then it is not just sufficient to make the changes in that particular certificate. The same have to be intimated to ROC, and the ROC should also rectify, or ROC should also certify this modification. Only then the modification would be legally valid. Only after certification the modification would be legally valid. Okay, so these are the important topics for today's class, and I conclude this today's class with this particular topic, and tomorrow we will see the remaining things. Okay, thank you so much for the patience listening, and we will see you tomorrow. Thank you.